Hello and welcome. I'm Saeed from StoryPlanet.net. Dive right into the essence of the most captivating books without reading them cover to cover. Whether you're on the go, at the gym, or just relaxing at home, we offer you a unique and enriching listening experience. Today, we are exploring the book Capitalism Without Capital, a creation by Jonathan Haskel and Stian Westlake. Capitalism Without Capital, 2017, discusses the rise of the intangible economy. Most developed countries are now prioritizing investments in intangible assets like software and research over physical assets like machinery. Despite lacking physical presence, these intangibles hold immense value. The book delves into this shift, its impact on business, the economy, and public policy. Before we delve into these revelations, it's interesting to note that Jonathan Haskel, an economics professor at London's Imperial College Business School, is a member of the Bank of England's Monetary Policy Committee. Stian Westlake, who previously led the science and innovation think tank NESTA, now advises the UK government's Minister for Universities, Science, Research and Innovation. With 9 key ideas to unveil, brace yourself for a deep dive into this captivating book on StoryPlanet.net. To start, focus on understanding the changing nature of the economy. The modern economy is shifting towards intangible assets like software and branding, where the true value of companies lies. Businesses built on intangible assets grow faster but are riskier for investors. This intangible economy necessitates government intervention to maintain investment levels. Key idea. Number 1. Economy is moving from physical assets to intangible assets. William the Conqueror's surveyors assessed the wealth of 11th century England by counting tangible assets. Economists now recognize the economic importance of intangible assets, like barcodes and branding. Businesses are increasingly valued for intangible assets, such as software and intellectual property. This shift signifies a move towards less reliance on physical capital in the global economy. Key idea number 2. The shift to an intangible economy is evident, despite being a recent development. The concept of GDP was created in the 1930s to measure economic production. Initially, it focused on physical investments, not intangible ones like research and development or software development. Over time, many developed economies have started including intangible investments in their GDP figures, showing their increasing importance. Investment in intangibles overtook physical assets in the US in the mid-1990s and later in the UK. In countries like Sweden and Finland, intangible investments are ahead due to tech and R&D sectors. The shift to intangible assets impacts business behavior and the overall characteristics of the economy. Key idea number 3. Intangible assets can lead to rapid and substantial growth for businesses due to their scalability. Starbucks relies on both tangible and intangible assets. While tangible assets like coffee machines have limits in scalability, intangible assets like operating manuals are scalable. Intangible assets can be used repeatedly and simultaneously across locations, enabling businesses like Starbucks to provide a consistent brand experience worldwide. In industries like tech, intangible assets, such as software and music rights, can be scaled massively without significant incremental costs, leading to rapid growth and dominance. Companies with highly scalable assets, like Google and Facebook, have a competitive advantage and make market entry challenging for new players. Market concentration in industries favoring scalable assets may become more prevalent in the future. Key idea number 4. Intangible investments are sunk costs with implications for financing and potential impact on future financial crashes. Banks prefer lending against assets like houses because they are valuable and immovable, making them easy to reclaim. Unlike tangible assets, intangible assets like brands have complex value and are hard to sell. This poses challenges for financing companies heavily reliant on intangible assets, as these assets cannot be easily seized or sold. In the event of a market crash, intangible assets may lose all value, leading to significant losses for businesses. Key idea number 5. Spillover effects, where businesses gain from the innovations of other businesses, are on the rise. In an intangible economy, assets like ideas and concepts can easily be copied by competitors, leading to spillover effects. This necessitates strong regulatory frameworks to protect intellectual property. Businesses must invest in networks and collaborations to identify and exploit competitors' spillovers to stay competitive. Key idea number 6. In an intangible economy, the fusion of ideas can lead to valuable synergies and innovative approaches. Innovation often emerges from the convergence of different ideas. The microwave oven's success stemmed from the fusion of technical microwave expertise with kitchen appliance knowledge, leading to a widely desired product. Synergies between ideas drive most innovations, creating new or improved solutions. Examples include Uber, which combined a taxi-like network with smartphone technology to revolutionize transportation. The intangible economy highlights the importance of synergies for policymakers, emphasizing the value of ecosystems that foster innovation. This economic shift also brings about rising inequality, a factor that has not been thoroughly explored by economists before. Key idea number 7. Economic inequality worsens due to the expansion of the intangible economy. Inequality in income and wealth is on the rise due to various factors, such as the growth of the intangible economy, which creates high-paying jobs and increases property values. Intangible businesses pay more due to scalability, affecting income inequality. Cities with a concentration of intangible investments see disproportionate property value increases, driving wealth inequality. Key idea number 8. The intangible economy's growth necessitates re-evaluating education and finance strategies. The introduction of electrical power revolutionized factory production in the United States by allowing each machine to have its own motor, boosting productivity. Slow adoption of electricity highlights the time societies need to adjust to innovation. To adapt to the intangible economy, governments should focus on adult education and finance reform. Encouraging adult education for immediate diversification and subsidizing bank loans against intellectual property can help nurture innovation in the intangible economy. Balancing investment in this sector can still be challenging. Key idea number 9. Public investment in research and development is valuable in an intangible economy. The text emphasizes the importance of investment in research and development in the intangible economy to prevent underinvestment risks and spur economic growth. It discusses the role of dominant tech firms like Facebook and Google in filling investment gaps, highlights the potential benefits of government funding in R&D, and presents evidence showing that increased research investment leads to economic gains. Policymakers are urged to acknowledge the unique features of the intangible economy and invest proactively to reap long-term benefits. In conclusion, investing in intangible assets is crucial as it differs from tangible investment. Success in the modern economy requires maximizing synergies and innovation in intangible-rich environments to maintain a steady investment flow. Thank you for listening to this summary. If you enjoyed this exploration, we invite you to discover other fascinating books on storyplanet.net. Don't wait any longer. A multitude of books, stories, and knowledge await you there. See you soon on storyplanet.net.